Hey there and welcome. Today, we're going to pull back the curtain on one of the most fascinating tools in any trader's toolkit, Fibonacci. So let's just dive right in and figure out what all the hype is about. When you first look at a financial chart, it just seems like pure chaos, right? Just a bunch of random spikes and dips. But what if there's a hidden order under all that noise? A kind of mathematical pattern that could actually help us predict where the market might turn? Well, that's the exact question Fibonacci trading tries to answer.
So the whole story really starts with this thing called the Fibonacci sequence. And what's wild is that you see this pattern literally everywhere in nature. It's in the spiral of a galaxy, the seeds of a sunflower, even the curve of a seashell. And here's where it gets really interesting. Traders believe that this same natural harmony, it also applies to the ups and downs of the financial markets.
So what traders do is they take the key mathematical ratios from that Fibonacci sequence and they overlay them right onto their price charts. The entire goal is to try and find some potential order in what looks like completely random price moves. It's all about getting a little bit of an edge, a clue about where the market might be heading next. When it comes to actually using this stuff, it really just boils down to two main tools that you've got to know. First, you've got Fibonacci retracement, and second, Fibonacci extension. They sound pretty similar, I know, but they answer two very different and very important questions for any trader. Let's just break this down nice and simple. Retracement, that tool helps you answer the question, where should I get in? You use it to find potential entry points when the market pulls back for a bit. Now, extension, that helps you answer, where should I get out? It's all about setting potential profit targets. So one is for your entry, and the other is for your exit. Simple as that. All right, let's talk about a retracement first. The best way to think about this tool is that you're looking for potential bouncing points. Imagine a market is trending up, but then it pulls back a little. Traders use these retracement levels to guess where that pullback might run out of steam and, bounce back up. These levels basically become potential zones of support. Now, when you pull this tool up on your charting software, you're going to see a few of these standard levels pop up. But look, don't let all the numbers overwhelm you, because while all of these levels are there, the trading world really focuses on just three of them. The first key level you gotta watch is 38.2%. In a really strong, fast-moving market, you'll often see these shallow pullbacks stop right around here before the trend takes off again. Next up is the 50% level. Now, here's a fun fact. This isn't technically a real Fibonacci ratio, but it's on almost every tool because it's the halfway point of a price move. It's a huge psychological line in the sand that traders watch like a hawk for a potential turnaround. And finally, we have the big one, 61.8%. This is often called the golden ratio. A lot of traders will tell you this is the most important retracement level of them all. If the price bounces from here, it's often seen as a really strong sign that the original trend is back in business. So if you're going to remember anything, remember these three: 38.2%, 50%, and 61.8%. These are the zones where countless traders are looking for the price to hit the brakes, turn around, and get back on the highway, so to speak. Okay, so you've used the retracement tool, you found a great potential entry point. Now what? Where does the price go from here? Well, this is where our second tool, the Fibonacci extension, comes into play. This tool is all about projecting where the price might go next, which helps you set logical profit targets. Just like the retracement tool, the extension tool projects these key levels out onto your chart, but this time it's beyond the recent price move. Traders are watching levels like 138.2% and 161.8% for signs that the trend might be getting tired. That makes them perfect places to think about taking some profit off the table. And really, that's the bottom line for this tool. It's not about finding where to get in, it's all about planning your exit. Knowing where you're going to take your profits is every bit as important as knowing where to enter. And Fibonacci extensions give you a really clear map for doing that. Now, these tools are incredibly powerful, but they're pretty much useless if you don't know how to draw them on the chart correctly. And it all starts with identifying two very specific points, something called a swing high and a swing low. So what in the world is a swing high? It's simple, really. Just think of it as a peak, like the top of a small mountain on your chart. It's a single candle that's higher than the candles on either side of it. Finding this peak is the starting point for drawing your levels. And a swing low? Well, you can probably guess. It's the exact opposite. It's a valley or a trough in the price. It's a candle that's lower than its neighbors.
Being able to spot these peaks and valleys, these swing highs and swing lows, that is the absolute first step to using these Fibonacci tools the right way.
Okay, we've covered the what and the how, but now we have to ask the biggest question of all, why does any of this actually work? I mean, is there some kind of magic in these numbers? The answer is actually way more fascinating than that.
And this right here, this is the real secret sauce. Fibonacci levels work in large part because millions of traders all over the world are looking at the exact same levels on their screens. So when the price gets near a key level, like 61.8%, what happens? Well, thousands of people put in buy orders right there, which creates a huge wall of support, and that causes the price to bounce. It works because everyone believes it's going to work. It becomes a self-fulfilling prophecy.
But, and this is a really big but, you have to remember that Fibonacci is not a crystal ball. It's a tool of probability, not certainty. For the best results, you should always use it with other types of analysis. For example, does a key fib level also line up with a major trend line? Do you see a bullish candle pattern forming at that support level? Getting these kinds of confirmations is what can really stack the odds in your favor.
So there you have it. We've kind of demystified these hidden patterns in the charts. We've seen how a sequence that shows up in nature can help traders find key entry and exit points, mostly because of this massive shared belief system. The only question left is, now that you can see the pattern, how are you going to use it to read the charts?